All right, now you've done all the work, right? If you tuned into Alice and I's last few Friday episodes, we went through beginning of putting together a real estate partnership all the way through. Now we're at buyouts and exits. This is what Allison always said. I'll let her say it. I'll give you. She has a phrase for this part, and she'll say it. Tune in. We're back with another episode of Wealth Building Made Simple. Our sponsor today is Rife Martin, CPA. Allison, you know this. You know the saying I'm talking about. What's the saying you always go back to?
I was going to say, besides show me the money, um, begin with the end in mind. And this one, again, the final harvest is as great as you planned for it to be. And in order to plan, you have to start thinking, what do you want? I want to make money. Well, how do I do it? I think this is going to be a great episode for that.
Awesome, awesome. So let's go into it. So talked about the deal, buy real estate, got an operations business on it, right? For the physical business facility, you talked about cost segregation to maybe front load depreciation. How does that benefit a high net worth money partner in the early years of the deal?
So I was going to say this leads into an interesting question to be thinking about. What is the end goal? Do you plan to exit in 5 years versus 10 years? Versus do you plan to just keep it so that, again, you can kick back and eat your bonbons as the money rolls in? And that will help determine whether you want to take bonus depreciation and do the cost segregation study, or maybe you want to spread it out over the life of the useful life of the assets. And here's why. If I do the bonus depreciation, I get immediate and wonderful tax savings. I will never say no to that. On the other hand, if I know that I'm going to sell it in 5 years, maybe I want to spread it out because at the time I exit, remember, if I'm doing an asset sale, it's based on the net book value of your assets. So if I did bonus depreciation, my net book value of my assets is zero.
Mm,
And then you buy the business for $1 billion. Well, guess what I'm paying tax on?
a
A
billion
billion,
dollars.
$1 billion. If I spread it out and at the time of the exit, my net book value is $200,000, what am I paying tax on? $800 million. You
Mm.
still have to pay tax. So you just have to weigh, you have to sit there and think, what is my end goal? And if I'm planning with the exit in mind, when am I going to sell it? Or when am I planning to sell it? And act accordingly for that.
So like a good rule of thumb might be, uh, like for somebody like me, my favorite holding time is Warren Buffett's forever, right? So I may want to, because I'll just borrow against it if I need to redirect
Right.
the cash flow. So like cost segregation for that type of thinker would probably be better than somebody who is looking to flip it at some point in time in the future.
Right. And even still, if you sit there and think, like you say, if I'm a Warren Buffett and I'm going to follow like the buy, borrow, die philosophy of continue to buy and borrow against it, you might still weigh the tax implications might still be take the bonus depreciation now and know that you've got another asset you're continually buying to offset that will offset the gains
Got it. Okay.
or potential gains, I should say.
When the partnership eventually returns the initial capital to the partners, so let's say they put in $1 million, we're returning their million, right? And um, I know it depends, right? So let me pick one. So let's say they didn't take the upfront cost
Hmm.
um, deal. Is that treated as a non-taxable return of basis? And what triggers it to become a taxable event if that's the case?
So it goes back to the example. You buy my business for $1 billion, and it's an asset sale. My net book value is $200,000. That's what makes it. That's what my share of the investment in the assets is. If it's a stock sale, then it depends on what's my fair market what's my equity in the business at the time of sale. Offset. I mean, there's a whole bunch of other things that go into it, but it depends on what type of sale, and again, how did you structure, say, the depreciation on the assets and a whole host of other things.
So at the end of the day, you'll just be looking at the capital account and then how we're selling it, because the capital account net accounting is gonna be like the hot, the decider, and then you're going, here's the number of the capital you put in as of today, and then
Right.
everything else is just how you plan to sell it.
Right,
Okay.
exactly. And most of the time the buyer wants to sell the whole shebang, but the buyer doesn't want to buy the whole shebang because I don't want to, you wouldn't want to buy the liabilities. You know what I mean?
Mm-hmm.
I think it's easier to do an asset sale.
Got it. Here's my last question. Like, how does goodwill work in this whole thing? Like is goodwill just something that you just like wave your hands and say this, and then your accountant makes it work? So how does the brand, like you built the brand, right? It's going to have some goodwill value because maybe, you know, this location has brand because of the connection with the community, which is valuable. You
Right,
can't just take the idea and put it somewhere else if you don't have the team and the community.
right. So if I'm the buyer buying the business that has, significant brand and like, you would do an analysis of what's the fair market value of the assets that I'm buying. And again, let's just pretend the fair market value of the assets is, or I'm going to buy it for $1 billion. The fair market value of the assets is 200,000. Well, then my goodwill is going to be $800,000. I'm going to amortize that over 15 years. And then when I sell the business, whatever the unamortized value of the goodwill will factor into the sales price too.
Okay. Okay.
So that maybe that was a little
And so
complicated.
no, no,
Sorry.
but it's gonna be an asset
Hmm.
that is gonna be treated maybe like a long-term capital gain asset, or is it like a capital contribution? Or am I using the wrong terms? I don't know.
So you are completely right. The goodwill is what's called an intangible asset
Okay.
because I can't see it. I just know it's there.
Mm-hmm. It's my
But
magic.
yes, yeah, it's my secret sauce that you just purchased, and so that does factor into the purchase price, as in terms of you as the seller, what's your share of the gain? You know what I mean? So like when I buy it for $1 billion, my balance sheet will look as follows: fixed assets, $200,000, goodwill, 800 grand, equity, $1 billion. That's how it's going to look. And then over time, you amortize the goodwill, like I said, over 15 years. And the fixed assets, depending upon your ultimate goal, you'll either do the bonus depreciation. And again, it still makes sense, or you might spread it out over the useful life of the assets, or what other options may be out there for you.
Got it. And so that matters for like when you sell. You're saying basically how you decide the cost on goodwill and how to itemize it is going to dictate like the taxes on the back end when you sell.
Right. So ultimately, it's what's the fair market value of the tangible assets first,
Hmm.
and that then the remaining amount is effectively goodwill.
Got it. And is that tax the same or different?
It's
All other things
it's
being
all
equal.
it's all they're all taxed as considered a deductible expense.
Perfect.
It's
Okay.
just the amount, and again, the timing of over which you spread it.
Perfect. Okay. They got all the wrinkles out for me.
Yes, hopefully we've ironed them well. So maybe I put a little starch in there for you too. So.
Some stay flow. Let everybody know how they can reach you if they want more information on this.
You can reach me at my website, rifemartincpa.com, or you can email me at info@rifemartinaccounting.com.
Thank you for sharing all of your knowledge and wisdom.
This was a wonderful series of episodes and a lot of fun. And seriously, you did pick great ideas.
That you give great answers. I appreciate you.
Have a wonderful day.
You too.
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.